In today's video, we're going to talk about building and rebuilding your credit report. This is not one of those videos which teaches you how to build your credit in 5 minutes and go from no credit score to 800, nothing like that, but a real way of building your credit long-term properly, the way it's supposed to be, the way that it will stay on your credit history forever. So stay tuned. In previous video, we talked about personal loans and why they're important and how they can help you build your credit, whether you're starting from scratch or you are somebody who wants to rebuild their credit, right? So today we're going to focus on credit cards. Credit cards are an essential part of evaluating someone's overall financial well-being. Credit cards are also known as revolving debt in financial industry. What it means is basically you will have access to a line of credit, $1,000, $10,000, $50,000, whatever the case may be, right? And by spending that line and making payments back, you are establishing a repayment history. That is what the bank wants to look at, wants to see when they're reviewing your credit report. They want to see history. The repayment history is where you borrow something and you paid it back on time, every month. And that gives the bank a point of reference of what your financial character is. So financial character is how would you handle your finances. So let's say you don't have any credit cards, any lines of credit. You just have those two personal loans that we talked about in the previous video in your credit report, right? So you want to apply for a small credit card. You can apply this through your local credit union or local banks or at department stores, basically. Now be careful, one thing about department stores, any card that you apply for, make sure does not have any annual fee. The reason for it is in today's market, the business is so competitive that credit card companies and lenders in general are fighting over themselves to extend credit, have their credit cards used by people, right? By responsible people, by financially responsible people. Because at the end of the day, they want to see those monthly payments keep coming in, right? So therefore, there is no reason for you to have a credit card which is carrying an annual fee. Unless you really know what you're doing and that annual fee that you pay to that credit card makes sense in general by those rewards that you collect back from the credit issuer. But for today's purposes, let's not make it complicated. Just focus on opening a credit card where there are no annual fees associated with it, right? Now apply for a secured credit card. Now secured credit card works very similar to a secured loan that we talked about previously. The difference is it's a revolving product, meaning that you are going to borrow against that line, that plastic, that card, and pay it back, and borrow and pay it back, and borrow and pay it back. Now one thing to keep in mind is you never want to utilize no more than 30% of your credit. So if you are having a $10,000 credit card, in reality, banks don't want to see no more than $3,000 put on debt. So that's something to be careful. Revolving debt utilization is what makes about 35% of your credit report, credit scoring report. So the good rule of thumb is you never want to go over 30% of your available limit. Now, if you have multiple credit cards, say you have a $10,000 card and you have another $20,000 card and you have another $5,000 card, so your total available credit is $35,000, and you just don't want to use no more than 30% of that $35,000, right? One of the reasons for that is anybody who is nearing to their 30% or higher than that on their credit card limits is showing a sign of financial stress. Because think about it, why would you want to pay interest rate on any amount if you can afford to pay it off, right? Banks view this as a financial stress, meaning that this individual who has applied for a loan with us is already struggling to pay off this debt. So you want to be very careful with that. That's one of the reasons that you don't want to go nowhere above 30% of your available combined credit lines limits. Let's say you open that secured credit card, you're gonna have, let's say, I don't know, $500 or $1,000. You put it in the bank, very much similar, just like a secured loan that we talked about previously. Open it up, put it in a savings account, the bank locks it, gives you a credit card. Now, you're gonna keep using that credit card for about 6 months and pay it back, but don't pay it off. So every month you will receive a bill, something around $25 to $30. If your minimum payment is $20, don't make the minimum payment. Make a little bit extra, a little bit more than just a minimum payment. That is, say, make it $35 or $50, right? And the reason for that is you want to show to the credit bureau essentially that you are not under financial stress. Now, in grand scheme of things, this is for someone who has, say, $50,000 line of credit and has used it, say, $20,000 of that limit. Now, the payment on that is pretty significant. So then, if you make a minimum payment, that's what the bank is telling you. So what I'm sharing with you is a general rule of thumb that not only applies to a small secured credit card that you open today, but in general throughout your life. When you have established credit and big banks and lenders are willing to give you big, huge lines of credit and they want you to go out there and spend, they encourage you with these rewards and points and everything. But when they send that bill to you, then you're looking at a significant minimum payment. Now again, don't make that minimum payment, make a bit over that. So if you're looking at a $500 minimum payment, make it a $600, $650. Ideally is you want to get rid of that kind of debt as fast as possible. So I say don't drag it out. Try to pay it off as quickly as possible. Hopefully you're able to do that. You should never allow yourself to rack up about $20,000 worth of credit card debt. However, for today's purposes, we are talking about smaller credit cards where it's a secured card. Maybe you put down a $500, $300,000, whatever. You want to make sure the bank sees, the credit bureaus see that you are not just making a minimum payment, you are not just maintaining the card, but you're working towards paying it off early. Now here's the thing. You don't want to pay off that statement balance every month. And someone can turn around and say, well, if I don't pay it off, then I will incur interest rate. And the answer is yes, you will have to pay some interest rate back on the amount that you have borrowed in the form of credit. However, again, today we are talking about building our credit. We are talking about rebuilding our credit. So you want to show good on-time payment history. You don't want to just pay it off. Now, when you pay it off, the bank will not have a point of reference except that this person paid off this credit card. Problem with that is for the intents and purposes of rebuilding your credit or building your credit, establishing your credit, that will not help you. Again, if you have already established credit, like the previous example, and you have so much credit card debt, you want to pay it off as quickly as possible. But if you are someone who just watching this video to know how to build their credit and how to get to that 800 score, along with the products that we talked about in the previous video, today you want to open a secured credit card, you want to make a payment, you want to show a payment history. The history is the key word. Open up a credit card, make payments on time every month. Now we are talking about secured credit card if you cannot qualify for regular credit card. And then after 6 months of on-time payments, you'll go to your bank or credit union and say you want to turn this secured card into a unsecured credit card, essentially a real credit card, right? And they will be more than happy to do that for you, because they'll go back, review your payment history and see, okay, he met all the necessary criteria to qualify for a regular credit card. What are they? On-time payments for 6 months. No slow payments. That's very important. There shouldn't be no slow payment. We talked about it previously. Put it on auto pay. Make sure you send that payment on the dot every month. The second item that they'll review is your revolving debt utilization. We talked about that, no more than 30%. So assuming you have maintained these 2 points well and clear, they will approve you for a regular credit card, perhaps with a few hundred or $1,000 greater limit than what you had on your previous credit card. So now once you have the regular credit card open, you have the secured credit card that you opened 6 months ago as well. You can close that and get your money back. Now a lot of people say never close a credit card, and that is true. However, today in your situation, this is a secured card, so it's okay to close a secured card, because number one, the credit bureau will show that it was secured credit card, not an actual credit card. Number two, it's your money that has been tied down in that card, so you want to close that and get your money back. Now that you have qualified for a regular credit card, ideally, from underwriting perspective, a responsible adult should have about 5 credit cards. I see people having 10, 15 credit cards. It's insane. Don't do that. Don't open a credit card where you get 20% off if you apply for a card. I see people have an Amazon card, Apple card, TJ Maxx, Macy's, Victoria's Secret, Home Depot, Best Buy, the whole 9 yards. Every store in the mall, they got a credit card with. And that is a different story on why you shouldn't do that. But just in a nutshell, without doing another video about it, just let me interpret that for you. That means, from underwriting point of view, means that you are someone who cannot control themselves when it comes to shopping. So the term is, a shopaholic is the term for it. You don't want to be viewed as a shopaholic when it comes to loan approval, underwriting review, and that's why you don't want to have too many credit cards. You don't want to have too few credit cards. 5 credit cards, maximum is maybe 7 credit cards. That's it. You really don't need more than that, because by the time you're done building your credit, and in subsequent videos I will get to it, you have established in a few years 5, 7 credit cards, each have about $20,000, $25,000 a limit. You just need to have few solid cards. They have good reward program, they have no annual fee, they have very low interest rate, and they're from reputable companies. You want to spread your credit inquiries, meaning your credit cards that you want to open. We talked about having 5 to 7 cards. Do them 1 at each month maybe, or 1 at every 2 months or 3 months. By the time, in a year's span, you have established 5, 6 cards, and they have decent limits. Now, every card that you apply, most likely you will be approved a little bit higher, maybe a few $1,000s higher than the previous card that is reported on your credit bureau. So after you have opened your first actual credit card, after that secured credit card that we talked about, the first real credit card, let's say that's $2,500 limit. The second card that you apply next month, it's gonna be, you wanna apply for $5,000. If they give it to you, fantastic. If they don't, they'll counter offer it to maybe $4,000, right? Great, take it, put it in your pocket, have a nice day. This third card, you're gonna wait about a month and a half, and then apply, and that limit you're gonna request a $75,000 to $8,000 limit. You see what I mean? And you will do the same thing, and the final card that you open, the fifth or seventh card that you open, should get you a $10,000 to $15,000 limit, depending on how you stage the steps, basically, right? Now, another point to be mindful of is when you're shopping for credit cards, there are a ton of websites online. You can just Google and have these multiple credit cards compared to each other and see who offers the better deal. But the key point that I would pay attention is the interest rate. Forget about the introductory rate or teaser rate, but the actual interest rate after that introductory rate has expired, what that could be. And most of these will give you a generic ad basically on the internet saying, well, it could be as low as, say, 5.99% to as high as 18%. That one, which these type of interest rates carry with the credit unions, it's a good card to go. If your credit is good, you're going to qualify for as close to that bottom interest rate as possible. But there are many credit cards out there with big banks as well that their disclaimer talks about as low as 15.99% to as high as 25.99%, right? So you don't want to start a card that best case scenario is going to give you 15.99%, which is really high interest rate. So that's another item that I would pay attention to. The second item that I would pay attention to is the card should give you good rewards. Make sure the card has a good reward program. Most cards, most reward form cards will give you, let's say, 1 point for every dollar that you spend, where you accumulate those points and you can redeem them for gift cards to any store that you like, or purchase airline tickets, or pretty much you can do whatever you want to do with it. They're pretty flexible. So I would definitely select a card that gives me a high reward points. I know, for instance, there are a couple of cards where their point system is structured in a way that it gives you 3 times of the point for restaurants or dine-ins, 2 times point for gas and grocery, and 1 time point for everything else. It varies. You have to read the fine print, really. So I would pay attention to the reward program as well. Now, there are cards that out there, again, popular with credit unions, that either will give you very good reward program, a very good point system, but charge you slightly higher interest rate, or will charge you slightly lower interest rate than what you would qualify, and then give you no rewards. And that's just by design. At the end of the day, again, banks are in the market to make money, so they're not gonna give you the lowest of the lowest interest rate, but also the rewards, and you can rack up so much rewards, which can translate into dollars. So are there cards out there that do this? Yes, absolutely. There are cards out there will give you the lowest interest rate possible with rewards. Fantastic. You have to search, you have to look for it, you have to find it, and I would definitely sign up with those type of cards. But in general, you want to find that sweet spot. You want to find that balance where you are not getting ripped off by paying a high interest rate, especially if you have good credit. You have established your credit and you don't need to pay that extra interest rate, that extra higher than normal interest rate, in the form of, well, I'm building my credit and this is the cost that I'm paying to build my credit. No, you did that, you paid those costs, and now it's time to enjoy the fruits of your labor, basically. So I hope you liked the video. Leave me a comment if you have questions, and hit that like button if you enjoyed the information, and see you in the next video.